Alright, Section 3, Strategy 2, Supply and Demand Zones. This one is all about riding established trends. Now, what's really fascinating about this setup is how strictly we define a valid zone. You see a lot of traders out there just picking any random old support level. That is not what we do here. An unmitigated demand zone has to be the exact origin point of a massive expansion move that caused at least 2 consecutive breaks of structure. If it hasn't broken structure twice, well, it simply hasn't proven enough strength to be a high-quality zone for us. The way we coordinate the timeframes here is brilliant. We use the 1-hour chart to map out these fresh, unmitigated zones based on those 2 consecutive structural breaks. And then, we just wait patiently. When the price finally taps back into that 1-hour zone, we zoom right into the 5-minute chart. We are not just buying blindly on a tap. We wait for a micro-market structure shift which tells us momentum is actually returning, and that needs to be followed by the formation of a bullish breaker block. To keep it super simple, a breaker block is just a failed order block that the price broke right through and is now starting to use as support. Again, the execution here is highly mechanical. Your entry is a buy limit order placed right at the fair value gap, located inside that 5-minute bullish breaker block. Your stop loss gets tucked strictly below the breaker block itself. From there, you ride the trade all the way up to the higher time frame supply zone. And you know what's really fantastic about this specific strategy? It has a continuation rule. If your first trade is already running in profit and the market gives you a brand new break of structure, you can actually safely add a second position at the next unmitigated fair value gap. Moving into Section 4, this is Strategy 3, Reversal Structure. We're looking to catch major market shifts here. This final strategy is specifically designed for catching those massive, market-wide turning points. You pull this one out of the playbook when a strong, extended trend finally just runs out of gas, and you want to catch the very beginning of an entirely new macro wave. The anchor of this setup is something called a change of character, or a chach. But listen, context is everything here. A valid change of character must come after a genuinely strong trend, which we strictly define as a trend that has made at least 3 consecutive breaks of structure. When the price finally breaks and closes above the most recent structural high of that long downtrend, it's a huge flashing signal that sellers have completely lost control of the wheel. Once again, we apply our top-down alignment. Step 1, look at your macro view, the massive 4-hour or 1-hour chart. You want to find that trend with 3 or more structural breaks. Spot the change of character and locate the unmitigated fair value gap tied directly to that shift. Step 2, you zoom way down to your 15-minute or 5-minute chart. You watch for the price to return to that big higher time frame gap, look for a really clear price rejection, and then wait for an inversion fair value gap to form. So, the absolutely crucial point here is adhering to the strict entry logic. You place your buy limit at the newly formed 5-minute inversion FVG. Your stop goes right below the recent swing low. Simple enough. But if you want to drastically improve your win rate with this setup, we use a mandatory confluence rule. You require the price to have filled at least 50% of that massive higher time frame fair value gap before you even consider entering. That single rule proves the market is actually rebalanced before it continues its new move. Okay, Section 5, Trade Risk Management. This is all about protecting your hard-earned capital. Look, you can have the absolute best entry models in the entire world, but if you don't aggressively protect your capital, gold will take it from you in a heartbeat. I want you to look closely at this number, 1.5. In gold trading, you simply cannot use fixed, arbitrary pip stops like you might on standard forex pairs. Because gold moves so wildly, your stop losses absolutely must be set at 1.5 to 2 times the average true range, or ATR. Doing this ensures your stop is placed safely outside the bounds of normal, everyday market noise, keeping you alive in the trade until the technical setup is genuinely invalidated. Let's quickly walk through these hard, non-negotiable risk rules we've pulled from the source data. You should risk only 0.5% to 2% of your account per trade. That's it. If you have multiple trades running at once, your maximum total exposure across all gold trades is still just 2%. As we mentioned, always use ATR-based stops. Never ever enter a new trade 5 minutes before a high-impact US news event. It's just gambling at that point. And finally, only take setups that offer a minimum reward-to-risk ratio of 1.5 to 1. Your position sizing has to be calculated based on mathematical volatility, never on emotion. Bringing this whole playbook together, here is your ultimate cheat sheet. It compares all 3 mechanical setups side by side. You can see the macro, higher timeframes flowing down to the micro execution, lower timeframes, alongside the exact entry triggers for every single one of them. It's a great reference to keep handy. Which brings us to our final thought for today's explainer. I want you to ask yourself, which of these three mechanical systems actually fits your personal trading psychology the best? Are you incredibly patient, willing to wait days for a massive reversal structure, or do you prefer the fast-paced intraday action of a 1-minute liquidity sweep? My biggest piece of advice: pick just one of these strategies to start. Choose the one that matches your patience level, master it completely using strict multi-timeframe coordination and risk management, and just watch how it transforms your entire approach to the gold market. Keep learning, stay disciplined out there, and I will see you next time.